All right, hello. This is our final S Corporation video, second of two, on distributions and taxes. So let's begin. The distributions to stockholders, we're going to treat them just like we do with corporations at fair market value. So unlike partnerships, where we take the distribution typically at partnership basis, here we're going to value all distributions at fair market value. If the S corporation has no subchapter C earnings and profits, meaning that maybe the corporation never was a C corporation, we elected S corporation status at the inception. Or it was a C corporation for a while, but it didn't earn any earnings and profits. Or it was a C corporation for a while and did earn earnings and profits, but distributed them all. So it has none now. If that is the case, that there are no undistributed C corporation earnings and profits, then life is pretty easy. All we need to know is what's our basis in the stock. Distributions up to basis are excluded from income. There's no recognition of income at all, but we do have to reduce the basis of the stock. For every dollar that we receive in distribution, basis goes down by $1. And as you know, basis cannot be negative. So distributions in excess of basis, you can't reduce the basis anymore once it's zero. And so therefore, now you're going to treat any additional distributions above that as gains on the sale of the stock. You still hold the stock, it has a zero basis, so you're going to treat that as probably a capital gain. If you've held the stock long enough, it'll be a long-term capital gain. Okay. Now, if the corporation does have C corporation earnings and profits, then distributions are excluded to income up to the balance in what we call the accumulated adjustments account. Now, that is one of those names that Congress has come up with. This one, you've heard me criticize their naming conventions before. This one is not really bad. It's just empty. There's nothing there. Accumulated adjustments account. What does that mean? There's no information there in those three words. It's some sort of an account in which adjustments have been accumulated. But that means any kind of account. All accounts are accumulations of adjustments. Anyway, that's the name we're stuck with. And I'll tell you all about what it is in just a second. But right now, just think of it as just this account that the corporation has, and we're going to exclude everything from income to the extent we have this thing. And then, once we use it up, well, first of all, we're going to reduce the AAA account and the basis of the stockholder's stock for every dollar that we take out of the accumulated adjustments account. And then once we've run out of AAA, we're going to treat any further distributions as distributions of earnings and profits. Those are taxable as dividends, and they do not affect the basis of the stock. You get a dividend, you recognize the income, you don't change the basis of your stock. Once you have used up all your AAA and all your earnings and profits, now you're basically back to where you were before. Further distributions are simply non-taxable, but you must reduce basis. If you've got any basis, once you run out of basis, capital gain on the rest. So you've got this thing called the accumulated adjustments account. You exhaust that, then go to earnings and profits and exhaust that, and those are going to be dividends. And then reduce basis to zero, and then treat anything after that as a capital gain. Now, what is this accumulated adjustment account? Think of it like accumulated earnings and profits if this was a C corporation, or on a financial accounting text, you would call that retained earnings. So this is an accumulation of essentially earnings. It's a very bad name because it doesn't give you any information about what we're doing, but that is what we're doing. So we're going to increase this account each year by the taxable income of the S corporation. And we will decrease it by all non-taxable distributions until you run out. Once you've run out, you wouldn't go negative. Now, the accumulated adjustments account can go negative if you have losses. Losses can make AAA negative, Distributions by themselves will not. You'll just leave accumulated adjustments account alone, and they will be non-dividend distributions using the old C corporation language that we've talked about. Okay. Back before 1982, when there was a substantial revision of Subchapter S, now I am not going to drag you through any pre-1982 law, but I did want to tell you that the thing that we're now calling the accumulated adjustment account was called previously taxed income. A much better name. They should have kept that name. I guess they didn't want to because there was this transition period where the old pre-82 rules were in place and the new pre-82 rules were being phased in. And so they wanted to keep previously taxed income for the old stuff. And so then they had to come up with a new name for the new thing, and that's what they came up with. But think of it as previously taxed income. That's a really good way to think of it, because what this is this is stuff which you have already paid tax on because it's been passed through to you as a shareholder. And so now that it's being distributed to you, you already paid tax on it. You don't need to include it in income again. That's what you should think of with the accumulated adjustments account. It is previously taxed income. Since it has been previously taxed, there's no need to tax it again. And when it goes negative, that's because you've had previously deducted losses. And you're going to have to get that thing up to zero before you can be distributing to yourself any more previously taxed income. Distributions, if all you've got is negative, those are going to come out of basis. All right. If the corporation has both positive accumulated adjustments account and positive earnings and profits, you do have the right to elect to distribute earnings and profits first. The general rule is you don't. You leave the earnings and profits in there. But if you want to get rid of your earnings and profits, and we'll see some reasons why you might, you can elect to say this distribution is coming out of E&P. So make that election. Your first distributions will be dividends and then out of accumulated adjustments account. The elective will be effective for all distributions made that year. So it's a year-by-year election. If that doesn't do the trick, if you didn't distribute all your E&P, you can make the same election next year and do it again if you want. Okay. And as we'll see, there are reasons to get rid of earnings and profits, but we'll talk about that later. All right. Treatment of distributions at the corporate level. So we talked about how the shareholders are going to deal with these distributions. What is the corporation going to do? Just like a C corporation, the S corporation must recognize gain on the distribution of an appreciated asset, an asset where fair market value is greater than basis. Now, the difference is in a C corporation, the C corporation is going to have to pay tax on that gain at 21%. S corporation is not going to pay tax on the gain, but they are going to pass through that gain to the stockholders, who will then pay tax on the gain. The S corporation does not recognize a loss if we have depreciated property being distributed where fair market value is below basis. That's just like the C corporation. Recognize gain when there's a built-in gain. Do not recognize a loss if there's a built-in loss. And the basis in the assets received in a distribution for the stockholder is always their fair market value. All right. Stockholders' basis in the S corporation stock begins with the original acquisition basis, and that would be rules governing a purchase. In other words, your basis is what you paid for it. Or a 351 transfer. That's one way to get your hands on stock of a corporation, and it works just as well for an S corporation as it does for a C corporation. Remember, the 351 transfer, that's all about whether the transferor recognizes gain or loss on the transfer of property into a corporation in exchange for controlling stock in that corporation. And so you can have a 351 transfer to an S corporation. Okay. And then your basis is going to be your basis in the property that you just transferred in. Also, gift and inheritance rules. If somebody gave you the stock or you inherited the stock, because someone, the former stockholder died. All of those things your basis would be determined in accordance with the normal rules for those events. Okay, that's your starting point. Now the changes in basis, we've seen some of them. Let's look at all of them now. Increases in basis, if you have taxable income items, that's going to increase your basis. Non-taxable income items, you're not being taxed on them. Things like state and local government bond interest. If the corporation has some municipal bonds and receives interest on those bonds, that interest will increase your basis in your stock, but will not be taxed. It'll be passed through to you, so you'll report it on your 1040, but you won't actually include it in your gross income. And again, any other addition into the corporation by further purchases of stock or maybe just contributions of capital into the corporation. So if you're the 100% stockholder and you decide the corporation needs another $25,000, you don't have to issue yourself more stock. Just make an additional contribution to capital and that'll do it. So those are the kinds of things that will increase basis. The decreases match right up with the increases. So deductible expenses and losses will reduce your basis. Non-deductible expenses. So if you have life insurance premiums or parking tickets that were incurred for a business purpose, but you can't deduct them, they will still decrease your basis. And then if further money put into the corporation increases basis, distributions will reduce your basis. Except for distributions out of earnings and profits, taxed as dividends, they will not. But everything else, all other distributions that are not taxable, will reduce basis. Okay, so essentially whenever you get money out of the corporation, it's either income because it's out of earnings and profits and therefore a dividend, or it's income because you've run out of basis and it's a capital gain, or it's a reduction in basis. So you're either going to credit income or credit basis in stock. One or the other is what's going to happen when you receive that distribution. Basis in stock cannot be negative. We already know that distributions in excess of basis will create capital gains. What about losses when your basis has gone to zero? You think, well, I can't deduct them. But actually, there is a way to deduct losses even if you've run out of basis in your stock. And that is if you have made loans to the corporation. So if the stockholder has lent money to the corporation, the stockholder is allowed to take the basis in that loan receivable from the stockholder's point of view, loan payable from the corporation's point of view, but the stockholder has a loan receivable and can use the basis of that loan and apply the losses and expenses and still get the deduction, but then reduce the basis of the loan. So you don't have to just forego deduction of losses and expenses if you've got loans outstanding to the corporation. Once you've brought your basis in your loan down to zero, corporation still owes you the money. It's just your basis in that loan has gone to zero because you took all those deductions. Okay, now the losses and deductions, once you've run out of basis, now you have to suspend them. There's nowhere else to go. You hit the stock, drop that to zero. You hit the loans, drop the basis in your loans to the corporation to zero. Now you've got no more basis to go to, and so you must suspend your losses. They're just carried over indefinitely until you can get around to use them, and you can use them if something happens that causes your basis to go back up above zero. Have an increase in basis. Have the corporation generate income. Then you can use you can offset that income with some of these suspended losses till your basis goes back to zero, and then you have to stop. Or you put more money in. Now you've got more basis, and you can now deduct more losses. If there are net operating losses from years when the corporation was a C corporation, they're just going to be sitting there. They cannot be used by the S corporation. Generally, see that word generally there? Well, that's because there is an exception, and we'll get to it before this video is done. But the general rule is if you've got S corporation income and a C corporation net operating loss, you can't just say, well, I'm going to use my net operating loss and I'm not going to pay tax on that income. No, you can't do that. Old net operating losses from back before, what was it, 2017, I guess, was the last year of the old rules. They had an expiration date. So you could go, under the old rules, you could go back a couple of years and forward 20. If you have those losses and then you convert your corporation to an S corporation, say, hey, if I'm going to have losses, I might as well be able to deduct them on my individual tax return. So you convert to an S corporation, but you've still got those net operating losses from the C corporation years. Clock is ticking on those. They expire after 20 years. And if you were an S corporation for those 20 years, oh well, the losses expire unused. So the clock keeps ticking on those C corporation losses. Now, starting in 2018, net operating losses don't expire. So it's less of an issue anymore. But under the old rules, that was an issue. You could have an S corporation just sitting on these C corporation net operating losses, and eventually they just disappear. You can't use them. Okay. Now, let's take a look at problem number 64. Germain is the sole shareholder of Nomad Corporation, and the basis of Germain's stock is $18,000 at the beginning of the year. Corporation had taxable income of $9,000. The corporation had a short-term capital loss of $1,200 and tax-exempt income of $800. What is Germain's basis in his stock at the end of the year? So this is just a simple increases and decreases in basis problem. So basis at the beginning of the year was $18,000. Now what happened during the year? Well, we have our non-separately stated income and loss, in this case income of $9,000. Germain is the sole shareholder, so he gets 100% of all items that happen to the corporation. So $9,000 of income is added to his basis. There was that short-term capital loss of $1,200. We're going to subtract that. That's a deductible loss. That's going to pass through to him, and he can deduct that. Just like any capital loss, he can deduct up to $3,000. So assuming he doesn't have other capital losses in his individual account, he'll get a full deduction for that $1,200. And then we have some tax-exempt income of $800. That increases basis. So those are the only three things that happen. No withdrawals, no contributions. And so basis at the end of the year, $26,600. Okay. Problem 67. Delta Corporation is an S corporation with an accumulated adjustments account of $8,000 and some accumulated earnings and profits. It says from the pre-1983 years. It used to matter whether this was from pre-83 or post-83. The phase-ins have all happened decades ago. I don't know why the textbook, well, you know how this textbook is. It doesn't update its problems very often. Anyway, so this is accumulated earnings and profits. That's all you need to know. And the amount is $12,000. There's one shareholder owning 100% of the stock, and that shareholder receives a cash distribution of $27,000. How are we going to treat that $27,000? They also said, by the way, the basis of the stock is $12,200. Okay, so the beginning balance in AAA, $8,000, earnings and profits, $12,000, and the basis of the stock, $12,200. Now, before we go any further, make sure you understand this. Sometimes I'll draw a horizontal line. I didn't do it on these slides, but sometimes I'll draw, a vertical line between earnings and profits and basis. I'll draw a vertical line in between those two, and the reason is because accumulated adjustments account and earnings and profits, those are corporate accounts. Basis is not a corporate account. Basis is the stockholder's account. So a vertical line between those two, you separate, just visually separate the two corporate accounts from the stockholder's account. So anyway, so imagine a vertical line between E and P and basis because we are not talking about three corporate items. We're talking about two corporate items and an individual item. Okay, so there was a distribution of $27,000. I'm going to break that up. The first $8,000 Assuming we didn't make any elections to the contrary, that's coming out of AAA, and that is going to reduce basis. So that's 8,000. We did 27,000 in total. The next 12,000 comes out of earnings and profit, and that does not affect basis. So now we're at 20,000. We've got 7,000 more to go. Well, the next 4,200, that's how much we've got left in basis. So if we started at 12,200 and decreased it for the AAA distributions by 8,000, there's 4,200 left. Now we have zeroed out both the accumulated adjustments account and earnings and profits. The next distribution is just a non-dividend distribution of 4,200. That will reduce basis. Now we are out of basis. So that last 2,800, not going to affect any of these accounts. There's our $27,000 of distribution, and our ending balances, AAA is 0, earnings and profits 0, basis is 0, and the stockholder has $12,000 of dividend income from the distribution of earnings and profits, and that last $2,800, that will be a capital gain. Most likely, I would expect a long-term capital gain. Okay, so what do we say? How will the distribution be recognized? 12,000 of dividends, 2,800 of capital gain. Everything else is not taxable. All right, 68. An S corporation has an accumulated adjustments account balance of 50,000 at the beginning of the year, accumulated earnings and profits of 20,000, and the corporation earns 40,000 for the year. So they gave us the beginning balance and then earnings. That is apparently the only, there are no separately stated items there. Apparently just non-separately stated earnings of 40,000. That's all we have. Now, there was a distribution of 120,000. The question is, what would the sole stockholder's basis have to be in the stock, basis of the stock, at the beginning of the year to avoid any capital gain reporting? Okay, that is a fascinating question. So they say, what is the basis in the stock, assuming that we did not report any capital gains? And so I just there we go. Put that in as an X. All right. It's the unknown. We're going to solve for X with this thing. So what they do, they started out with those two balances and an unknown amount of basis. We'll have to figure that out. And then the income for the year was 40,000. That will go into the AAA account, not into earnings and profits. It will be added to basis. That gives us 90,000 in our AAA. We're still at 20,000 from our old C corporation earnings and profits. And basis is now X plus 40,000. Okay. So now that distribution, it was 120,000. The first 90 comes out of AAA, and that reduces basis. The next 20 comes out of earnings and profits and has no effect on basis. And the final 10 will reduce basis. There's your 120. So we're going to reduce basis by 10,000 because we are assuming no capital gain. So that means we had to take that last 10,000 out of basis. Okay. So AAA once again is 0. Earnings and profits, we have zeroed that out. And now what do we have in basis? It's X minus 60,000. We were at X plus 40. We subtracted 100,000 from the distribution, and now we're at X minus 60. That number cannot be negative. X minus 60 must be 0 or positive. So the basis to avoid a capital gain must have been greater than or equal to $60,000. I think the solution manual actually says equal to. Okay, fair enough. Equal, but obviously if it's greater, you'll also avoid a capital gain. Okay, so that's how to do that one. It's basically the same table we had in 67, just this time we had to use a little algebra, not very hard algebra, 4th grade algebra, to get to maybe 7th grade algebra. Anyway, to get to the the solution of x is greater than or equal to 60,000. All right. Now, taxes. There are some taxes paid by the S corporation. There's something we call the tax on pre-election built-in gains. There is a LIFO recapture tax, and there is a passive investment income penalty tax. Remember, we briefly touched on that last one in the last video, because we talked about how if you have too much passive investment income, not only do you pay the penalty tax, after 3 years of that, you get kicked out of S corporation status. So we talked about it in terms of being a way to terminate, probably a not very smart way to terminate your S corporation status. It will do it, but there are a lot easier ways and a lot cheaper ways to do it than that. Okay, well, let's talk first about the tax on pre-election built-in gains. If we have a C corporation with appreciated property that elects S corporation status, and then the S corporation sells that property within 5 years, that's when you may have to recognize and pay a tax on the pre-election built-in gain. So the election we're talking about is the election of S corporation status. And before that, it was a C corporation with appreciated property, fair market value greater than basis. And so what Congress is saying here is, hey, wait a minute. Those C corporations, those are subject to double taxation of income. Pay tax at the corporate level, and then you have earnings and profits, which are then distributed to the stockholders and taxed again. Are you going to try to dodge that by saying, oh, we've got appreciated property? Well, quick, let's elect S corporation status, so when we recognize that income, it'll just pass through to the stockholders, and it won't increase our earnings and profits, so we won't have to pay tax a second time, just the first time. And they say, we're not going to let you do that. If you have property with built-in gains and you elect S corporation status, and then the S corporation turns around and sells that property within 5 years, we're going to see if we might tax that pre-election built-in gain. So the tax base is going to be the recognized built-in gain. So you sold the property for a particular gain. What was that? The whole built-in gain? Let's use an example here. You made the election, the property was worth $100,000, but your basis was only $30,000. So tract of land that appreciated in value while it was a C corporation. Now you've elected S corporation status. You got that $70,000 built-in gain. Now you sell it for $120,000. That's a $90,000 recognized gain, but only $70,000 is the recognized built-in gain. So that's going to be your tax base. Okay, so that's the thing. Or on the other hand, what if you sold it for $80,000? It was worth $100,000 when you made the election, but then the value dropped back down to $80,000 by the time you got around to selling it. And so you actually only have a $50,000 gain. Well, that's all you recognize was $50,000 of that gain. That is all you're going to have as your tax base. So it's not necessarily the total built-in gain. It's the built-in gain up to the amount that you recognize, but not more than the original built-in gain at the time of the election. Okay. The tax rate is going to be your maximum corporate tax rate, which nowadays is the same as your minimum corporate tax rate. It's 21%. Okay. So, limitations on that built-in gains tax base. First of all, Congress said, what if the year in which you recognize that gain was otherwise not a particularly good year for you? They say, okay, your tax base for that year will not exceed the corporate taxable income for the year, and that is computed using C corporation rules. So figure out what your taxable income would have been if this thing was still a C corporation. And if that number is smaller than the recognized built-in gain, then reduce your tax base to that amount. But that is not going to get you out of paying the tax on the total recognized built-in gain. It's just going to defer it. So anything that you didn't put in your tax base this year because of the corporate taxable income limit is just going to come back and hit you next year, subject to next year's corporate taxable income limit. So maybe it'll take a few years to use it up. Generally speaking, in all the examples I've ever seen, you use it in 1 or 2 years. But anyway, so that's the first limitation, that you're not going to exceed corporate taxable income for the year. You'll get a deferral of the recognition and the taxation of that tax base. You'll get a deferral, but you won't get a permanent waiver there. The other one is that your total recognized built-in gain for this corporation cannot exceed the corporation's aggregate net built-in gain. So what's going on here is that, imagine the stockholders, they say, well, wait a minute now, we just elected S corporation status on the whole corporation. Yes, there was that tract of land in there, which had a fair market value of $100,000 and a basis of only $30,000. Yeah, that had a big built-in gain. But there was other stuff on our balance sheet that had built-in losses. You know, so what the heck? You're hitting us on the built-in gains, but not giving us any credit for the built-in losses. And so Congress said, yeah, okay, that's true. That's fine. We will let you calculate your aggregate net built-in gain. Aggregate means for all the assets in the corporation's balance sheet, and net means net of any built-in losses. And if the corporation's aggregate net built-in gain is only $50,000, then even if you recognized a $70,000 gain on the sale of that land, you're only going to have to actually pay tax on a tax base of $50,000. And that's a permanent reduction in the tax base. That's not coming back at you next year. The corporate taxable income one, then you just get a carryover. But this one, your total recognized built-in gain. So if you've got 5 assets, summing to a total built-in gain for those 5 assets of $70,000, but the aggregate net built-in gain is only $50,000, well, then when you recognize the built-in gain on those assets, once you hit $50,000 in total, you can stop. You don't have to pay tax on any further built-in gains than that. Now, the aggregate net built-in gain, aggregate fair market value of all the corporation's assets minus the aggregate basis of those assets. So aggregate, because we're taking into account all the assets, net because we are netting out any built-in losses. Okay, and so now, then they said, well, wait a minute. We put that rule in. How are people going to abuse it? They're going to go and do a 351 transfer of some built-in loss property just to get their aggregate net built-in gain down. Because now you've said, well, we're not going to tax you on anything above your aggregate net built-in gain. So let's reduce that as much as we can. Let's throw in some built-in loss property into this corporation. Even though there's no business purpose for doing it, it'll get our aggregate net built-in gain down. Well, they say any built-in loss property that you contributed in the 2 years leading up to the election of S corporation status, we're not going to count that. So aggregate net built-in gain is calculated as we see there, value of all the assets minus the basis of all the assets, but take out any built-in loss property contributed in the last 2 years before the election. Okay. Now, the built-in gains tax, you can kind of think of this as a deductible tax. We get to reduce the amount of recognized gain because, of course, if you recognized a built-in gain, that's just because you recognized a gain, and that gain is passing through to the stockholders. Well, if you had to pay tax on that gain at 21%, at least you do get to reduce the amount of the gain that passes through to the stockholders by the built-in gain tax that you paid at the corporate level. So it's almost like you get a deduction for the built-in gains tax. Here's the one exception. Remember I said you cannot use the C corporation net operating loss, except there's one exception. Well, here it is. That recognized built-in gain that you have to include as your tax base, that you have to show as a tax base and pay 21% on it, you can use your C corporation net operating loss to reduce the built-in gain tax base. So if you've got in the situation we've been talking about with this $70,000 built-in gain on the land and an aggregate net built-in gain of $50,000. If you've got a $50,000 net operating loss, then as soon as you have to recognize that gain, you just use some of your C corporation net operating loss to wipe it out and you don't have to pay the tax. And so that's the only way you can use the C corporation net operating loss during the S corporation years. Otherwise, that thing is just sitting there waiting for you to convert back to a C corporation. And if you don't, for old losses, if you don't do it on time, it's over. For the new losses, 2018, 19, and later, you just wait until you eventually turn this thing back into a C corporation, if indeed you ever get around to it. Okay, let's look at problem 56. Doom Corporation. I want a corporation called the Doom Corporation. This has changed from a C Corp to an S Corp. For 2019, the corporation has built-in gains of $40,000, taxable income of $30,000. So, in other words, a recognized built-in gain that was from appreciated property held while the corporation was a C corporation. So there was a built-in gain of $40,000 that was recognized in 2019. Okay, and taxable income computed using C corporation rules would be $30,000. So the tax base for our built-in gains tax is the built-in gain of 40 or the taxable income of 30. The lesser of those two is obviously 30. The tax rate is our old friend 21%, and so the built-in gain tax is $6,300. And that $10,000 that we didn't use, we're going to have to carry that forward to 2020. So even if we don't recognize any more built-in gains, even if there are no more built-in gains to recognize in 2020, we're still going to have to calculate a built-in gain tax of $2,100 unless our taxable income in 2020 is low enough that the limit will be below $10,000. Otherwise, we're going to have to pay the other $2,100 in 2020. With the 2020 return, actually. So in 2021 probably is when we get around to paying it. Second of the three taxes is the LIFO recapture tax. And I think of this as almost like a special case of the built-in gain tax. Because what do we know about LIFO inventory? The newer prices are the ones that go into cost of goods sold, and the older prices are the ones that are sitting in inventory. So if you have a corporation that's been using LIFO for a while, there's going to be a lot of really old LIFO layers, or there could very well be a lot of really old LIFO layers sitting in ending inventory. And so you could get to the point where the basis in your inventory is significantly less than the value of that inventory. And essentially what they're saying here is if you have a C corporation that's been using LIFO inventory, there's a built-in gain right there in the amount of the difference between LIFO inventory and FIFO inventory. So here's the rule. This applies to a C corporation that uses LIFO in the last year before it makes the S election. By the way, when you're writing handwritten notes, be very careful of how you write S election, because you go back and read it later and it says before us N selection. N selection of what? No, it's an S election. Okay, anyway, so the LIFO recapture tax applies to a C corporation that's using LIFO. Now it's made an S election, so next year it's going to be an S corporation. We've got essentially a built-in gain. What it says is include in income the amount of the LIFO reserve. I don't know if that's what they call it in tax. That's essentially, that's what we call it in financial accounting, the LIFO reserve. FIFO inventory minus LIFO inventory. That difference has to be included in income. So essentially you're grossing up your inventory to FIFO at that point by including the LIFO reserve in income on the C corporation's final 1120, the C corporation tax return. And that's for the last C corporation year. Okay. The additional tax is paid in 4 annual installments. The first one, the first quarter of the additional tax. So you figure out what would your tax be without this additional income? What would your tax be with it? The difference, probably 21% of the LIFO reserve, is the change in your tax. And that you can divide that into 4 annual installments and pay the first one with your 1120 for the C corporation final year, and then the last 3 with your 1120S for your S corporation. This is a C corporation tax. Notice we're including this in income on the 1120 on the C corporation's year. So this really isn't an S corporation tax per se, but it's triggered by the S election. And the last 3 quarters are made by the S corporation. So it's definitely related to an S corporation. If you didn't make the S election, you wouldn't have this tax. So definitely related to S corporation taxes. But technically, you're calculating it, and it's a tax that is assessed on the C corporation. But 3/4 of it is paid by the S. Okay, that's the LIFO recapture tax. Finally, the passive investment income penalty tax. This tax applies to a corporation with undistributed C corporation earnings and profits. So if you don't have any E&P in your corporation, you're never going to have to pay this tax. And remember what the condition was for termination of the S corporation status. It's if passive investment income exceeds 25% of gross receipts for 3 consecutive years. Well, here, if passive investment income exceeds 25% of gross receipts, then the tax applies. Passive investment income is defined as interest, dividends, rents, royalties, annuities, almost like personal holding company income, although you don't have those crazy tests for rents and royalties. If you can show that your business, the business of the corporation, is collecting rents or generating royalties, then you can leave that out of there. But generally, or actually generating interest, if you can show that the business of your corporation is, maybe you're collecting interest on notes receivable from customers. That would be business interest and would not count as in passive investment income. But if you're just investing in stocks and bonds and rental property with excess corporate earnings, then they're saying, hey, you should be distributing those earnings. So this really is very closely related to the personal holding company tax for C corporations, or even in some sense, the accumulated earnings tax. It's all about, why aren't you distributing these earnings? I know why you're not distributing these earnings, because you've got C corporation earnings and profits in there and you don't want to pay tax on the dividend. Well, we're not having it. We're going to assess you if your passive investment income is too high. And how much is too high? 25% of gross receipts. Now notice, that's gross receipts. That is not gross income. That's good news. Gross receipts is revenue. Gross income is revenue minus cost of goods sold. So it's 25% of a bigger number, which is better for the taxpayer. Okay, so there's your passive investment income in most cases, as long as none of these are strictly business related. And your net passive income, that's just your passive investment income as we've defined it, minus any directly related expenses. So any expenses you have directly related to the production of that income. So you've got some passive rental property that you own, but you pay a manager to manage your rental property for you. Well, then the payments to the manager would be a related expense, and your net passive income would be net of that expense. Okay, the tax base for the passive investment income penalty tax is called excess net passive income. So take your passive income, subtract out 25% of gross receipts. What fraction of total passive income is that? And let's slide that over and insert net passive income, which we just defined as passive investment income minus related expenses. And so what fraction of your total passive income is excess? Apply that fraction to net passive income. That is your tax base, excess net passive income. The tax rate is our old friend, 21%, the maximum corporate tax rate. So there it is. So we have a problem here, problem number 57. What is the passive investment income tax on an S corporation that has gross receipts of $200,000, passive investment income of $80,000, and expenses directly connected to the production of the passive income of $10,000? Okay, so net passive income, 80 minus 10 is 70. 25% of gross receipts, 200,000 times 25% is 50,000. Excess net passive income, 70,000 times 80 minus 50, that's our excess. Passive income was 80, 25% of gross receipts was 50, and then divide that by 80. So that's 30 over 80, that's 3/8. 3/8 of 70,000 is 26,250. That is excess net passive income. So the passive investment income tax is 26,250 times 21%, which works out to be $5,512.50. That is your passive investment income tax. And you had to pay that because you had earnings and profits. They didn't actually say that you had earnings and profits in this corporation, but you did. Any amount. If you had $500 of earnings and profits, you would have to pay $5,512.50 because you owe the passive investment income tax. What do you do about that? Well, one of the things you do about that is you say, why do you have all that passive income? Let's get rid of some of it. You could also try to increase your gross receipts if you can. That's not always as easy to do. You got to get more customers to do that. But one thing you could do is you could distribute that $500 of earnings and profits. Remember, you can distribute earnings and profits first. And if all you've got is $500 of earnings and profits, make that election. Say the first $500 I distribute is coming out of earnings and profits. And you have to pay tax on that at the shareholder level. $100 maximum, maybe less. Because the maximum rate on dividend income is 20%. 20% of 500 is $100. It's going to cost you $100 or less to distribute that earnings and profits, and we'll save you $5,500. So yeah, you're going to want to do that. Okay. This is how you make your money as a tax advisor. You tell your client, looks like you're going to owe about $5,500. You know, it's November. The year's coming to an end. Maybe you should distribute $500 to yourself. We'll call it a dividend. What? I don't want to pay that dividend. No, it's fine. You'll pay about $100 on the dividend, but otherwise we're going to have to pay $5,500 passive investment income tax, and you probably don't want to do that. And the client says, yes, thank you very much. I don't want to do that. And you just saved me $5,400. I will happily pay your $2,000 bill that you charged me for telling you that. Okay, so there you go. That is the passive investment income tax. And so we are done with S corporations, which means we're done with the book. The book is done. No more books. That was me closing the book. Thanks. Bye.